welcome everyone. Thanks for joining us. Today, we're going to discuss how behavioral science can be leveraged to increase access to small dollar loans. Before jumping in, we just want to thank the JP Morgan Chase Foundation for their support of this work. And we also want to thank our partner, People's Advantage Federal Credit Union, for their collaboration and commitment throughout the project. We're also going to have some time for Q&A at the end. So if anything comes up that you want to ask us about, feel free to use the Q&A feature at the bottom of your Zoom window, and we'll get to those questions at the end. I'm joined today by two of my colleagues here at Ideas 42, Vivian Caetano and Tahan Menon, as well as Justin Cousins, the Chief Risk Officer at People's Advantage. And I want to start by answering a question that some of you are likely asking yourselves. What is Ideas 42? Well, we're a nonprofit organization that focuses on applying insights from behavioral science, the study of why people do what they do, to help improve social problems around the world. Specifically in this context, we're leveraging behavioral science to ensure small dollar loans are delivered in a way that helps more people have a more financially secure present and a self-determined future. But that's enough about us. We want to hear a little bit about you. So we're going to go ahead and launch a poll that has a few quick questions just so we all get a better sense of who's in the room today. So we'll give everyone a minute to share a few things about themselves. And then once it looks like most people have responded, we can just go ahead and share the results. It's always interesting to see, people's baseline familiarity with behavioral science, obviously their baseline familiarity with small dollar loans. All right, give people 5 more seconds. All right, looks like everyone can see the results now. All right, so we got a pretty good mix. Good, that's good. Thanks for humoring me there. It's always great to know who's in the room, especially when we can't see or hear each other. So because we have people from different professional backgrounds, I just want to make sure everyone's on the same page before we get started. So I'm going to be doing a little less moderating up front and a little more stage setting. People across the country need access to affordable credit to meet their financial challenges, with roughly 40% of Americans needing to borrow money in case of a surprise $1,000 expense. And there are biases in a lot of systems that lead to people of color being especially exposed to financial disruptions. And on top of that, they're disproportionately targeted by high-cost predatory lenders. And small dollar loans have the potential to meet this need. They're short-term, low-cost loans of generally $2,500 or less, and they can be up to 15 times cheaper than the high-cost predatory loans people often turn to, like payday loans. More often than not, loan decisions are made based on alternative data like cash flow, how long someone's been a customer, and other factors that can be more equitable than using someone's credit score. And they're offered by all sorts of financial providers, from banks and credit unions to small community development financial institutions, and even some non-depository lenders. This means that tens of millions of people whose credit scores have previously excluded them from formal loans could soon have access to affordable small dollar credit. But there are still questions about whether these loans will actually live up to their promise. On the one hand, we've heard many providers question whether they can make the product sustainable and whether they can offer it at scale. And we know that simply having the product available doesn't mean A, that it'll actually reach people, B, that they'll use it, or C, that it'll actually improve their financial health. On the bright side, this is the exact kind of space where there are a ton of opportunities for behavioral design. All right, so that's some background, but what was this specific work about? Well, Our goal was to develop a wide variety of strategies that a range of financial providers can use to maximize the sustainability and impact of this product. To do this, we identified behavioral barriers preventing people from applying, and we did so across different types of providers with a specific focus on barriers for low to moderate income customers. We then generated behaviorally informed strategies to address these barriers, and we worked with a variety of organizations across the industry to ensure that the strategies are both actionable and applicable. All of this culminated in a behavioral design guide that financial providers can leverage to increase the uptake of their small dollar loans. I'm going to share more about this at the end, and I'll make sure everyone knows where they can go ahead and download this guide. Now, those organizations we worked with didn't just come in at the end to check our work. We consistently worked with them over the past year, and we're grateful for them sharing insights and providing feedback. They included broader industry players like Credit Builders Alliance, Inclusive, Local Initiative Support Corporation, and QCash Financial, as well as a handful of individual financial providers across the nation. We also independently reviewed different small dollar loan products being offered by a variety of financial institutions. And on top of that, we partnered with People's Advantage, where we were able to dive deep into their small dollar loan offering and interview their customers. I'm now going to pass it over to Justin to introduce himself, his credit union, and their loan product.
Thank you, Dan. I certainly do appreciate the introduction. And like you said, my name is Justin Cousins. I am the Chief Risk Officer at People's Advantage Federal Credit Union. And I'm going to just kind of give you some insight on who we are as a credit union. And then I'll also delve a little bit into our product that we had examined with our partnership here with Ideas 42. So People's Advantage, we are currently headquartered in Petersburg, Virginia. We are a low income designated, and we are a CDFI. As Dan alluded to earlier, a lot of the folks who they may participate with on this are community development and financial institutions. We are in that box. We serve that market, and we have done so since 2018. We currently are a little bit on the smaller scale side of things. When you think of financial institutions, we are currently right around 98 million in total assets. And right now we're looking at multiple initiatives that we currently have underway. What we specialize in is financial literacy, helping folks build and repair credit. We also have programs designed for first-time home ownerships to try to help break any generational wealth gaps that may exist. And also auto lending for reliable transportation to and from work. And something more recently that we also started participating in is in micro business lending as well, to try to help out the small businesses and the CDFI census tracts. What we look to do is we like to provide with this small dollar loan product that we examined. We wanted to have a product that did not require traditional underwriting. We wanted to make it something that was much more relationship based with the credit union to try to help build on that trust component, that help folks feel comfortable borrowing from us in a judge-free zone where there's no traditional underwriting involved. And so we have a fast cash product that we launched in partnership with QCash Financial. And we actually launched this product originally in August of 2021. And this was a product that we felt was a huge need and a lift for our communities here, because there is a lot of payday lending exposures in this part of Central Virginia, where the consumers would pay upwards of over 300% APR on their loans. So we offered a fast cash product that is labeled as a payday alternative loan under the NCUA, who is, that they govern credit unions. And so this product it's at a 28% interest rate, which may seem a little high, but compared to the 300% plus that folks would have over time, it certainly is a big savings. And it is a traditional style loan product where it's amortized up to 12 months. And they can also have it builds credit as well. So we also report these loans on the credit bureau to help folks build credit instead of just, forking over huge amounts of interest and fees and getting caught in a vicious cycle. We would not have a payday alternative loan product if we could not convert folks over to a traditional loan product in the future and get them on a path of traditional lending. And so the last time we did an impact report from 2022, we were right around 99% of memberships that do partake in payday alternative loans. They do convert and essentially over to traditional loan products with us, so that way we can help continue for them to build credit and hopefully some generational wealth as well. So with this loan product in particular, It is very quick, judgment free. It will look at the deposit history and the relationships that they have with the credit union. And they can be anywhere in the world as long as they have access to our mobile app. Wherever they are at, they can actually apply. And within 1 minute, they can have the small dollar loan up to $2,000 funded into their checking or savings account here with the credit union. So it's very efficient, eliminates a lot of hurdles, and provides a very significant need for our members.
Yeah, thanks, Justin. And we really appreciate you joining us today and sharing your expertise with our audience. And also, just for people who might not be too familiar with small dollar loans in general, just want to note that they don't all necessarily look like this. They're gaining in popularity, so different providers have different offerings. But this giving you some context about People's Advantage's specific offering. All right, so jumping back into the kind of the B-side behavioral science stuff, based on our structured interviews with People's Advantage members, as well as our review of different products and discussion with various industry players, we identified these 5 behavioral insights about what might keep people who could be eligible for a small dollar loan from applying. Some of these barriers contribute to people not even considering small dollar loans when they need money, or to them actively deciding against using a small dollar loan, while others matter more when it comes to actually making it through the application process. So, of course, these are all in addition to the many structural barriers you're familiar with: inequitable access to banking, low wages, technology constraints. Our goal here isn't to claim that these are the only barriers getting in people's way, but to add to this conversation with the behavioral perspective. I'm now going to pass it over to Vivian, who's going to start talking about these barriers in more detail.
Thanks, Dan. Hey, everyone. As Dan mentioned, my name is Vivian. And before I jump into the barriers, I briefly want to zoom out for a moment. So at Ideas 42, we look at how our innate psychology interacts with the world around us and how that interaction can influence us to make certain decisions or behave in certain ways. Now, it's no surprise that we cannot change what's in people's heads. But luckily, changing the context people operate in can have a meaningful impact on their behavior. And there are always things we can't change, right? We can't change the fact that predatory lenders are out there, at least not without policy change. But our goal is to identify pieces of the context that can be changed and that can improve people's outcomes. And I want to note that there's no such thing as a context that doesn't influence behavior in some way. So it's up to us to design contexts that really do support people's goals. And if we're going to be designing products that support people with low to moderate incomes, it's important for us to understand what it's like to live with a low to moderate income. So these folks are managing complex financial lives. They are making things work with not enough money, and they're constantly problem solving because of it. Then on top of that, living without much money is not forgiving. Right? A single mistake can have really big impacts on your credit score, on your debt levels, and even whether you can keep your job or your home. And this is why folks get so good at managing their finances, why they are able to develop such sophisticated systems, or why they have to develop such sophisticated systems. They really can't make a mistake. So when these folks are hit with an emergency expense that they can't cover, say their car broke down, that's going to be on top of managing their already complex financial life. Now, when any of us are in this kind of situation where we are spending a lot of mental energy and time staying afloat, we aren't able to deeply consider or research our options for getting money. Instead, we tend to default to our existing choice set, right? What have I done in the past when I've been in this situation, or what have I heard other people like me do? Then we look at that choice set and we decide which option is going to work best for me right now. Which one's going to give me the amount of money I need? Which one's going to give me money when I need it? And which of these options am I most okay with? Often there isn't a good choice. People are aware of that. They know they're sort of stuck between a rock and a hard place, and they're choosing the best option in that choice set that's available to them. So the challenge for small dollar loans is that they are not in people's choice set, right? They're not something people think of, especially not when they're dealing with a scarcity of resources. And that brings us to our first barrier of scarcity. So research shows that when we are chronically dealing with a lack of resources like money, that scarcity affects how we make decisions, In the case of people who would be eligible for a small dollar loan, scarcity can lead to people using solutions already in their choice set, as I just mentioned, or it can reduce their likelihood of considering new options or navigating cumbersome processes. Now, predatory lenders know this and they are designing for it. You can see just on these few images, they make what they're offering really clear, right? How much money you can get, that you can get it today, what you need to do to be eligible. And these lenders are also doing other things. They've optimized their processes so that they're incredibly convenient in terms of location, but also just the steps to get the loan, right? Show up with your bank card and proof of employment. If you have a question, just walk in, right? They are designing for folks who are dealing with financial scarcity and who are navigating that complex financial life. All people who need money, these folks just need to fix this one immediate problem right now because they have to move on to other things that they're juggling. So I want you to keep scarcity in mind throughout the rest of this webinar, because even when we're talking about and designing for other barriers, scarcity is still at the center of how we think about and design for folks with low to moderate incomes. So that was predatory lenders and sort of looking at how they do design for scarcity. Meanwhile, when we looked at existing small dollar loan products, we sometimes found the exact opposite. And throughout today's session, we're going to be using these mock-ups of a fictional bank to illustrate some of the trends that we saw in small dollar loan products. So finding small dollar loan products on banks' websites is not intuitive. In some cases, like what you see on the screen, you'd have to open up the loan section of the menu. Then you need to know that the small dollar loan is listed under personal loans. And you might be thinking, well, that makes sense. It is a personal loan. I just want to point out that other banks had it listed in other places, like under line of credit. So even if you know to click into personal loans, you then still need to navigate a page that's not designed with scarcity in mind. So you need to scroll all the way down to the bottom, and then you need to read through and distinguish between different types of loans. And I want you to imagine that you're dealing with not having enough money to cover something. Maybe it's your car, a medical bill, and it was this hard to even find basic details about a small dollar loan. You would probably revert to something that you know better or that is easier to find. So what can small dollar loan providers do here? I'm going to share a couple of strategies, and these and everything else we share today are a taste of what's in our report. We dive in deeper there and offer other strategies as well. So one strategy is to make sure you're putting the most important details about the loan up front and to make sure that you're stating them simply, right? And I've added a mock-up here. This is from our report of one way to do this. Then another important tip is to remind customers proactively about your small dollar loan and to do so at strategic moments, right? You want to get into people's choice set at that moment when they're trying to make that decision.
Vivian, I just want to jump in quickly to ask Justin a question. Justin, what have you learned by strategically sending messages? I think, you talked about specifically around the end of your holidays, November, December, and then also what are your thoughts about maybe other times of the year?
Yeah, so we actually, while we were going through this exercise with you all, we launched a targeted campaign right around the holiday season. So it was late November. And it was really targeted to unexpected holiday expenses, or if there was some trouble finding a need, since the payday lending in Virginia has become more and more scarce, but the need still exists. And so we launched a campaign directly around that concept. And for a shop our size, we saw an enormous response. We had over 200 applications received within the first 48 hours of launching that, and we funded $286,000 in small dollar loans in 1 week because of that. And we didn't pull anybody's credit. We didn't do anything, at all to kind of pull wool over the eyes. We were very upfront and honest about what you could be approved up to, what it took relationship wise with us to be approved for that loan, and saw a pretty huge impact. And in fact, my client services rep, Caroline at QCash, actually reached out to me and said, "What did you do differently? Your queue really blew up." And so it definitely worked. And so for us, like looking at different times of the years and seasonalities where we know budgeting could be tight, whether it be around, folks want to take a vacation, or if folks want to be able to go for back to school shopping, or anything along those lines that we typically can see. So some hurdles, we can certainly be able to target this and to be able to make sure that, we can provide access to these types of loans that our members do need.
Yeah, that's great. Really, really identifying those moments of need, those times of need, and meeting people where they are. Also want to call out something from the Q&A, which I don't think the audience can see just yet, but we'll make that public in a moment. Maybe some validation or some additional supporting evidence to back up what Vivian was saying. It looks like the organization Raise Texas also researched credit unions in Texas and similarly found it very, very difficult to find small dollar loan options. Also calling out that customer service wasn't super helpful. So thank you for sharing that, Marina. And back to you, Vivian.
Thanks, Dan. All right, so next we found that many customers have mental models or perceptions about formal loans that keep them from even considering a small dollar loan, which is itself a formal loan. So these mental models can range from customers thinking of formal loans as for a large expense or a large purchase like a home or a car, right? They don't think of these loans as something to use for an $800 expense. And then we also saw mental models where people thought of formal loans as something that would have strict requirements and that they likely wouldn't meet those requirements. And they also tended to think of formal banking processes as time-consuming. Now, the thing about mental models is that people will continue to use their mental model until they are told or experience otherwise. And to show you what I mean, I want to look at our fictional bank again. And I want you to imagine that you have the mental model that banks are strict and that you are unlikely to be eligible for any loan product at a bank. When you read this first bullet, does not require traditional underwriting, you're probably still going to think that the requirements are strict, right? This isn't telling you otherwise. It's just telling you what it's not going to do. And you may not even know what traditional underwriting necessarily entails, right? Then the same thing applies for that second bullet. If you're someone who thinks of bank processes as time consuming, you'll probably think quick still means a few days because it is a financial institution, or that easy isn't actually as easy as some of your other options. So providers need to be aware of these mental models and actively work to counteract them. And even if you're, say, one of the non-bank providers, right? Maybe you're not a financial institution. It's good to know what people's mental models are about what you do and who you serve, because it's going to affect how they interact with your products. So our design strategies are aimed around helping address mental models and shift mental models. So the first thing you want to do is highlight how your small dollar loan is different from typical loans. And you want to use that plain specific language. So for that mental model that loans are time consuming, you don't want to say quick application, but apply in 5 minutes. Or if you're trying to attract customers who might expect that they won't be eligible, you want to highlight what is required to be eligible and do that using that plain specific language, right? So a checking account that has to be open for 3 or more months and no overdraft charges in the past 3 days. Those are very specific and concrete, and people can sort of check them off pretty easily.
Thanks, Vivian. I just want to remind everyone that we are going to be answering some questions at the end. So go ahead, use that Zoom Q&A feature to start asking your questions. We'll start thinking about the answers, and we'll be able to answer those at the end. Tahan, over to you to continue our conversation about the different barriers we uncovered.
Thanks, Dan, and thanks, Vivian. So I'm Tahan. I'm going to walk us through the next 3 barriers that we'll discuss today. The third one is ambiguity or aversion. And broadly speaking, what we're talking about is the fact that people prefer options that have predictable and certain outcomes over choices with unclear or uncertain outcomes. So how does ambiguity show up for someone who's never used a small dollar loan before? Well, first, they might wonder, am I even eligible for this loan? Now, while providers and policymakers are understandably excited about the potential for cash flow underwriting, the same decision process is often a black box for customers. They usually have questions about both its nature as well as its outcome. And now, in contrast, many products from payday lenders have a straightforward eligibility and approval process. It's a matter of bringing me your pay stub and a valid paycheck or a valid check, and we'll give you money. But even when customers don't have questions about their eligibility, they might still be unsure if their bank or credit union will meet their specific borrowing needs. They might think maybe the bank will take too long to make a decision, or will qualify me for less than what we need or what I need. Prospective borrowers can also be unsure sometimes about the cost that's associated with their given small dollar loan. So what does all this ambiguity mean for applications in particular? Well, options that feel less ambiguous, like a payday loan, can become more attractive despite their increased cost relative to uncertain alternatives. And now this is especially true for individuals who are living in scarcity, who just have less room in their lives for misjudgment and need a predictable solution. And then when we turn to the framing around small dollar loans on websites and in other places, we found that most of them don't provide the clarity or transparency that would be needed to reduce this ambiguity for customers. So for example, many banks offer borrowers a range for the loan amount that they will be lending, and then provide very little direction regarding how much the typical borrower would be approved for. So if someone logs onto the website, needs $700 and finds a small dollar loan with a range between $100 and $1,500, like in this example, they might be unsure if they'll be approved for that full amount. And this can potentially lead to them reconsidering if the application is worth their time or effort that it's going to take. And then when communicating about the speed and ease of the application process, banks frequently resort to generic adjectives such as quick or real time. Now, Vivian already laid out how mental models about banks can make these terms mean something quite different from what providers intend. But these terms also contribute to ambiguity aversion as they just lack sufficient specificity on their own. And this is, again, in stark contrast to payday lenders that offer a fast food-like clarity in the framing of their product. So what can financial institutions do to reduce ambiguity for customers? Well, Vivian already mentioned a few strategies when discussing mental models, such as using specific and plain language, and that can also help to reduce the effects of ambiguity aversion. Providers can further serve prospective borrowers by being transparent about both their decision process and, just as important or crucially, the enhanced inclusivity of cash flow underwriting. So the example on this slide demonstrates one way of doing this by providing specific criteria that would likely make someone eligible for a loan, such as customer tenure, so being a customer for 12 months, and deposit behavior, receiving a paycheck of $1,200 every couple of weeks. This type of framing is also really helpful or can be crucial for clients who are not currently eligible at your institution. For example, upon learning about the specific deposit behavior attached to eligibility, maybe there's a customer who's currently splitting their paychecks between a couple different banks or credit unions who will now realize that a closer or more exclusive relationship with the one bank offering the small dollar loan will increase or may increase their odds for a small dollar loan approval.
Jahan, I'm just going to jump in real quick. Justin, last time we talked, you mentioned that you want to solve the problem of letting people know what they need to do to be eligible for a loan.
Yep.
Could you tell us a little bit more about that?
Yeah. So one of the common themes that we saw, and when you interviewed some of our membership, and the ambiguity that Tahan mentioned was there, and you know, make myself vulnerable here a little bit. It still is to quite a degree, and I think what is being proved here is that you can remove a lot of that ambiguity to really shore up exactly what they can expect when they go to utilize that product. And when you can do that and then also execute that, and it happens exactly the way that it's shown to them, then that builds trust in your financial institution too. And so then now you know, from a credit union's perspective, you know, I manage risk, and so ambiguity is probably a friend of risk because you don't want to guarantee anything, but you don't necessarily have to guarantee anything. And I think that was the biggest point that I learned from this exercise was you can remove that gray area quite a bit. You know, folks, if they can see what the ideal situation, if they fit that mold, then they have a good idea of what to expect. And then once you execute that as expected, it builds that trust relationship, and they feel much more comfortable, you know, conducting business with you going forward. And honestly, it would lead to a much more improved loan performance as well.
Yeah, and my ears just perked up when you said trust, because that's a perfect segue into our next barrier. So Tahan, back to you.
Thanks, Dan. And yeah, thanks, Justin, for that transition. So another barrier that banks and credit unions may face when thinking about expanding the reach of their small dollar loans is the lack of trust between traditional financial institutions and some communities. And I'm thinking especially of communities of color. Now, we don't have the time today to do full justice to this topic, but it's important to keep in mind that people often have valid reasons for not trusting their financial institutions sometimes, and that this will have ramifications for small dollar loans. I did want to mention two broad trends today, though, that we found in our research that speak to this distrust. The first is that customers are not always expecting such a wonderful product to be delivered by their institutions or their traditional institutions. There's definitely a sense of this being too good to be true. And secondly, customers have had a history of experiencing unexpected fees or other costs associated with their traditional banking products and are understandably sometimes skeptical that the small dollar loan is actually as cost effective as some of the marketing materials might suggest. Now, when you have this lack of trust in mind, you also start to see how seemingly small or innocuous choices or missing details on websites and in other framing can matter a lot. So for example, in the fee description on this slide, the hypothetical provider has hidden the existence of a fee in the footnotes. Now, the spirit of the decision is to highlight the cost competitiveness of the small dollar loan, but customers who notice this will feel like the bank or credit union or other institution isn't being trustworthy and is hiding something. For those customers that don't read the footnotes, and let's be honest, this is most of us, and later get hit with a fee, that can feed into negative narratives about financial institutions not being trustworthy, that can reduce the desire to take out future loans, and just as crucially, or just as importantly, the way that people talk about this loan or communicate about this loan to others in their network and in their community. Now, we're not suggesting today that changes to small dollar loans or the framing around them is going to fully resolve this lack of trust. That's going to take more time as well as broader efforts. What we can do, though, is offer some design strategies that can reduce the impact of this lack of trust on customers' decisions. One strategy, which we've mentioned a couple of times already, but it's worth mentioning again, is the importance of being transparent and specific about the terms and conditions of the small dollar loan. This is helpful for a variety of reasons, but it's also helpful for managing issues of a lack of trust, as there's less room for people to suspect that things are being hidden from them. Making it easy for customers to hear about their peers' experiences is also crucial and can help a lot. So this type of signaling can act as a shortcut to legitimacy and help to overcome some of the levels of mistrust that people may have. So in the fictional testimonial on this slide, we've included an example of Vivian, a small dollar loan customer who didn't think she'd be approved for a loan. So hearing stories like Vivian's or testimonials like Vivian's, in this case, receiving a small dollar loan in less than 5 minutes to help sort out a car issue despite her poor credit score, that can be a powerful signal to prospective borrowers that their financial provider cares for them and will find ways to serve people like themselves. And on to the final or the last barrier that we'll talk about today, which is hassles. So hassle factors are small impediments or obstacles that can get in the way of achieving a goal or a task. And while these obstacles can seem small, they can have a disproportionate income or impact on the outcomes that we want to achieve. So for example, the hassle of needing to schedule a doctor's or a dentist appointment can keep people or can keep us from getting much needed care. Now, survey research around small dollar loans suggests that borrowers place a premium on speed and ease of access. So folks are especially likely to be tripped up or discouraged by any hassles that they encounter in their small dollar loan application. But you might be thinking, given the relative ease of most small dollar loan applications, such as Justin's at People's Advantage, that there aren't a lot of hassle factors that play a large role in limiting access. However, when we look closely across a full range of small dollar loans, we did find that hassles cropped up in a variety of places, including when individuals were gathering information about the loan. For example, websites often use technical terms or jargon without providing an adequate explanation of those terms, and that can lead to confusion or disengagement. And as we've mentioned a few times previously, information that's really valued by customers is also frequently included at the footnotes or only at the very bottom of a web page. So for example, this screenshot of a fictional small dollar loan website, which is based on a number of different landing pages that we audited, doesn't let the customer know that their loan requires a qualifying checking account open for 6 months until the footnotes. Now, it's unlikely that customers ever scroll this far down, let alone read the footnotes. And that opens up the possibility for some providers of rejecting applicants who might not have applied had they been aware of these requirements. And hassles or hassle factors also emerged when customers needed help with a given application. Customers have lots of questions about small dollar loans, and seeking help with those questions can often be a potential drop-off point. So for instance, if you cast your eyes to the third footnote on this landing page, prospective borrowers are only provided with vague directions to contact customer service if they want more information about a feature of the small dollar loan. This adds unwanted steps to the process. You need to find the customer service number, then you need to take the time to make the call, and there's other steps that I don't have the time to go through. Each one of those steps could be one hassle too many. And that's especially the case if we consider the counterpoint of physical payday loan stores that have people that can manage customer concerns and answer questions as and when they arise and in person. So what can we do? Well, the first step to addressing hassles, of course, is identifying them. If you find that you have an application or you have a lot of people starting an application, but then never completing it, or maybe taking too long to complete it, that suggests that there may be hassles in the application that need to be removed. Providers can also make it as easy as possible for clients to find help through customer service. And going further still, providers can proactively offer help to overcome hassles that cannot be removed. So for instance, imagine you're a provider who's struggling with rejected applications because ineligible clients aren't applying because they're not setting up direct deposit ahead of time or fully repaying an existing loan. To help those clients, what you could do is send messaging such as on this slide, prompting them to take action to become eligible well before their need for liquidity arises. So being proactive in this manner can ensure that hassles, whether they're small or large, don't escalate and prevent access to credit when people need it most.
Thanks, Dahan. And Justin, you told us something interesting about making it easy for customers to get help. Would you mind sharing that with the audience?
Yeah, so I think when things go very well, and it's a very seamless process, and that's like with our product that we partner with QCash, it can be where they literally could be in a checkout line and they have an emergency come up where, oh, I need extra groceries, and they can literally rather than check a line, they can get the loan funded and approved. And while that's a barrier-free experience, not everybody lives through that. And so when we had our membership surveyed, I think when you look at these barriers, it's around clarity of what would cause you to be declined versus approved, and also like a lot of the questions that we got on the back end, the majority of the process is very seamless. But when you get those members that say, I don't really quite understand the denial reason, or I don't quite understand why it would let me apply for this loan, and being very upfront about any exclusions or any things that would prohibit them from being approved, something that we felt after this exercise was very important for us to be able to disclose upfront to members, as well as what you can take to get approved, but also there's some things that just won't work, and we're happy to have that conversation with them one-on-one, provide a direct number, and we can go from there if there's any issues there. But yeah, that was something that we probably, especially early on, didn't do a well enough job of those barriers of saying, hey, this is what would cause you to not get approved for this loan, and here's the reason that you would receive as a result of this too. It's something that we are continuing to work on, about providing explanations for those turn down reasons too, versus just providing the adverse action reason.
Yeah. And that also, goes to show that no matter how easy you might make the application, right? 6 clicks, 60 seconds, mobile, do it from your phone. People might still have questions, or they might not even have questions. They might just want that reassurance before they feel totally comfortable applying, whether that's because they've been denied in the past, or, maybe one of their friends or family members got denied. So really just looking for that reassurance.
Yeah, we get that reassurance question quite a bit too. Thanks for bringing that up, because a lot of times we get the call out like, will I be approved for this, or is it really this easy, and is it really that fast, or did I even do it right, even though the money's in my account, did I do it right? And we still get that question too. So that's a very good point too. And being able to articulate those conversations and navigate those members through that experience without needing them to have to go through any barriers to contact anybody in our member services area is something that we've identified through this partnership as being very crucial for the long-term success of the program.
Yeah, absolutely. All right. So that concludes the presentation portion of this. We have about 10, 15 minutes left for some Q&A. So again, if you haven't done so already, pop your questions using that Q&A feature on the bottom of your Zoom screen. Before we get into that, I just want to take a moment to promote our larger body of work. So this webinar was just a little taste. We have plenty more design tips for you all in our actual guide. You can go ahead and download our full report to dive into our full list of strategies that providers can leverage to increase the uptake of small dollar loans. We'll make sure everyone has that link. If we can't share it in the chat today, we're going to send a follow-up email. And then you can also download our one-page checklist. It's a little more manageable. You can print it out, keep it on your desk, frame it, put it up on the wall, whatever you want. And oh, perfect. It looks like we got the link in the chat. So go ahead and click that link right now. Make sure you save that, bookmark that website, download the report. And yeah, we'll get into the questions right now. I'm actually going to stop sharing my screen because we only have this little Q&A title slide. So I'm going to stop sharing. And I'm going to, let's see if I can find these questions. But Vivian, you had something that you wanted to add, right?
Yeah. I just want to jump in and mention that a lot of our work and our goal here has been to highlight barriers and highlight challenges that customers might face. So I do want to acknowledge the great efforts that credit unions, CDFIs, and other providers are making to ensure that this product is getting out there, that it's accessible, that the requirements are not keeping people out. So we have highlighted challenges here because we want to encourage sort of thinking about how to make those pieces better, because they do seem to be affecting whether people feel like they're eligible or end up applying. But I want to acknowledge that there is a lot out there where folks are already doing these things, and a lot of our ideas actually came from some of those providers. So we didn't just want to talk about the negatives.
Yes, thank you. Thanks, Vivian, for clarifying that. All right, I'm gonna start asking some questions, and feel free as I'm asking questions, continue throwing. I see some good ones already, so we'll get to those. But Justin, I want to start with you. You know, you've been working with Ideas 42. You've been working with us for the past year or so, and you've kind of touched on this a bit already. But how has the behavioral approach informed how you think about your small dollar loan product?
Well, for us, it helped reinforce a few things that we assumed, and a lot of this is around the behavioral science pieces, and is this the psychology of money, and our members are very modest means, and so we hang our hat on that, and we take pride in serving those members, but we also understand that they lead very complex financial lives. They have to juggle a lot of different things with modest means, and this really allowed us to have a very fresh perspective on how we view products that we offer to our membership. To, you know, the goal is always to help them, but anytime that there's always consequences on both sides, and being able to understand at a much more detailed level of what we can do to make sure that the product offerings that we are intending to help our members are helping them 100% of the time, or as close to 100% of the time, while also, instilling their trust in us as their financial services provider. That's the biggest thing. And being able to provide something that is an alternative solution that's very affordable for them overall was the other piece here that we really, as a huge takeaway, that our members actually, they did overall, and they, I know we talk about barriers a lot, they do love our product overall when these surveys were done, but it was an eye-opener for us to kind of see it from a very different lens of the psychology behind it all. That was very intriguing to me, for sure.
Yeah, absolutely. And it looks like we still have some questions filing in. I have a question for you, Tahan. And then Vivian, feel free to jump in afterwards. A lot of the design ideas we talked about today assume that someone's already eligible, right? But how would we use behavioral design to increase eligibility of potential borrowers?
Yeah, no, that's a great question, Dan. So I think the first thing to recognize is, yeah, some of the things that we've been mentioning today will change. So if we cast your minds back to when Vivian started presenting about the barriers and specifically about scarcity, this loan isn't, or small dollar loans aren't always in people's choice set, or it's not always top and front and center in their minds when they're looking to meet a liquidity need or an emergency expense comes up. So for currently ineligible customers, if you think about sort of if they get rejected when they apply to a small dollar loan or find out that they aren't eligible, that's obviously not a great feeling given the fact that they're experiencing scarcity, they need an answer, they're moving on straight away, right? And so even if you think about messaging them about what they can do to become eligible, so for example, opening up an account at the institution or maybe increasing their direct deposit or paying off an existing loan, that isn't the urgent task at hand. What is finding that liquidity. And so it's not the most opportune moment to get currently ineligible clients on that pathway towards eligibility. Instead, I think one of the ways that you can go about doing that is what I was talking about towards the end of the webinar, which is getting ahead of the curve or getting ahead of those most acute moments of scarcity for your currently ineligible clients. If you know which customer profiles are likely to need the small dollar loan in the future, target messaging around getting them or making them eligible at that point in time where they have a little bit more freedom or a little bit more bandwidth to take those actions, like opening up a checking account or increasing their direct deposit.
And I want to jump in here and connect to something that Justin, you actually sort of started to touch on as well, which is around denied borrowers. So one of the strategies we also talk about is around preparing denied borrowers to become eligible. And the reason this is important is because it's a new product. There is confusion about what requirements are and whether people are eligible. So that means that people who could be eligible are going to be rejected. And if they expect to be eligible and then get rejected, there's lots of opportunity for frustration, for feeling lied to some extent. So it's really important at that point of rejection to think about managing it, right? And there's a lot of behavioral design that can help ensure that people feel motivated to come back and to feel like they're likely to get that loan next time.
Yeah, thank you, Vivian. Thank you, Tahan. I'm going to plow ahead. We're getting quite a few questions here. So, Justin, this one's probably for you, but maybe if you just wanted to speak a little bit more about maybe not specifically your underwriting criteria, but maybe more around like the benefits of cash flow underwriting versus, looking at someone's credit score.
Yeah. So with this approach, and I saw a couple of questions relating to this, and I'll try to bundle them all in as much as I can in relation to the questions that I see here. So for the underwriting perspective, it's solely based off of a few things. One is one barrier that we actually are testing to remove was length of membership. We wanted somebody to have some history with us, whether it be 3 months or 6 months. And we're piloting removing that barrier right now and saying, hey, that's day zero. If they meet the criteria, let's see if we can approve them, and let's see if we can monitor those loans and see how well that they perform. And so we're doing that. And in terms of what the criteria is, so the length of membership is something that we're not looking at right now while we gather some loan samples there when they do get approved. But basic requirements such as the loan amount that they're approved for, it can be as low as 300 or as much as 2,000. It's based off of the factors such as their direct deposit history or their overall deposit history. We don't look just at direct deposits because some folks may not have that option. And so as long as they have frequent deposits into the account and we do a look back by X amount of days, we can then assign limits based off of total deposit activity. And then the other aspect is if they pay us well, they have other loan products with us, they graduate to other terms of a loan. So whether it be auto loans or even, a mortgage loan, they can also earn additional, ability to earn a little bit more on their approval amount based off of their relationship and if they repay us well as well. So, and then the very top question up here too, I kind of hit that too, because I think around eligibility, I think this is an important question. From a credit union perspective, yes, they do have to be a member of ours. That's something that is, we don't have control over that right now. But the eligibility for membership is something that credit unions are getting very, very good at really getting creative in how they can expand their charters and to gain more members. And then also on the question on the TINs, there is no barrier for TINs with this product. If there is a member who has a TIN, they qualify for membership. We can certainly still, this loan does not exclude them whatsoever. We don't really have that much of a need where we are right now. I think we have a very, very few TIN accounts. But as we get closer and closer to the Richmond area, that's certainly something that's on our radar to expand on. So great questions around that.
Yeah, and also great questions all around. I don't think we'll be able to get through all of them. Maybe have time for one or two more. Justin, maybe you want to throw this one back to you again. There's a question, maybe there might be two questions in there about feasibility of offering customer service at scale. I realize you're not a huge financial institution, but I'm curious if you had a perspective on the feasibility of scaling customer service. Like, is it possible to provide that one-on-one customer service to loan customers?
It is. It can be difficult. So we have 33 total full-time employees that manage all of our products, and so it can be a daunting task. And we used to offer a payday alternative loan product through normal application standards where it was a normal employee, and we weren't able to, just the demand, we weren't able to get to all of them. And so that's where the partnership with QCash was so vital, because we can automate the need to look back and see the qualifications piece. So that way, when we do have these conversations with these members, it's much more impactful around what are their life goals? What are they trying to do financially with their life? How can we help them get there, convert to traditional loan products, and to stay away from whether it be predatory lenders, or now that, hey, payday lending may not be an option where we're at in Virginia right now, but employers are now offering like payday advances on paychecks, reducing net pay amounts, and now they can't meet the other financial obligations. This product helps solve all of those needs. And so that's really, being able to have conversations pinpointed around those things that we're seeing that are affecting their lives is really where we can take that now, versus it being a loan application type conversation.
Yeah, absolutely. We have time for probably one more question, but before we jump to that, we want to get some feedback from you all. So we're going to launch one more quick poll. I'm going to ask Justin this last question. So hopefully you can quickly fill this out, give us some feedback, and then we can, hopefully not go over and cut into your next meeting times. But Justin, we had a question around maybe that pilot process you mentioned. So could you tell us more about what you have to keep in mind when you test a change in your underwriting methods like this? How do you properly experiment with something like that equitably?
It's for us, it was we started at where we wanted the end result to be, and we worked backwards from there. And I think that's like, hey, this is the product that we want, and who can we partner with to get us where we want it to be? And then we really work backwards where we are current day from there, and then basically we're able to build a prototype pretty quickly. I think in terms of any type of exclusions, it's things that we would have to exclude just because we are a financial institution, or it just doesn't really make sense to, and it would like guarantee loss situations. In terms of being equitable, it looks just at what is coming into us, and there is no other factors that play into it. And we do monitor our loan portfolio. As we are a CDFI, so we have to make sure that, even with this product, because anybody can utilize it, and folks from all ranges of credit scores utilize this product, and for the convenience. So it really just, but we have to make sure that our loans are 60% in these census tracts too. So we do measure these and making sure that we're doing what they needed to do, and been very successful in hitting all those marks.
Yeah. That's really helpful context. I know we probably at this point only have like 30 seconds or so remaining. So I want to be respectful of everyone's time. I'm going to cut us off. I apologize that we couldn't get to everyone's questions. Thank you very much for asking those questions. Extremely thoughtful questions. Hopefully, I think some of those questions are answered throughout the guide. So go visit that link, download the report. If you still have questions at the end of that, we have our email addresses in the report. Send us an email. We're happy to maybe schedule some time to chat, answer your questions over email. But again, we really, really appreciate you joining us. Thank you, Justin, for sharing your expertise with everyone. And yeah, have a great day. We'll follow up with this recording. We'll share the slides, and we'll share that report link out again as well.